Right, good afternoon, everyone. And then if more people join, we'll just let them in as we go. But we have got sort of a limited time um, limit on this. So today's webinar is with the lovely Sammy from Castle Trust Bank.
Hello.
And Castle Trust Bank are very much in the specialist sector, and they offer a range of products across bridging, development, and also specialist buy-to-let. And so what we're going to do, we're going to break it down into sections and in products. And if each sort of segment of where Sammy talks about a product, we'll be able to offer a Q&A. And also um, we can answer any questions that you may have, and then we'll move on to the next product. And then like we have done on these previous webinars, Sammy will be here when the webinar finishes for a while. So if anyone wants to phone to the office and talk about something specific, you'll be able to speak directly with the bank on that. So is everyone ready? And we get this show on the road. Right, over to you, Sammy.
Hello. Thank you ever so much for joining this session. Hopefully there'll be something in there for each of you to be able to take away. And Sean said, happy to follow up afterwards if you've got any questions or any specific scenarios you want to discuss. Our three main areas of lending within the bank are for bridging, which can be light refurb, a drawdown facility bridge, and then buy-to-let term lending as well. So I'll cover each of those different products, and do feel free to stop me as we're going through if you've got any questions. Everything that we do is unregulated, so we're only lending on investment properties. So for those of you that look to buy securities, refurbish them, to either then sell on at a profit or retain within a portfolio, that's really our area of expertise. So I'll start talking about the light refurb product to start with, which can be used by anyone from a first-time buyer, first-time landlord with no experience, right up to experienced developers. It could be done via an SPV or an individual name. What makes us very unique in the market at the moment is the fact that we can lend up to 80% net against the security value day one, which if you're an investor or developer means that you've then got more cash available to you to be able to move on with the project.
Can I just interject there?
Absolutely.
What I wanted to say about this, which makes it a bit of a game changer, is when we look at standard bridging from many other lenders, they typically only lend at 70% net or 65% net. So to be able to get that 80% lending is unusual within the general bridging market space, and very much a USP of Castle Trust.
Absolutely. Most of our competitors are out there about 75% net max, not the 80% that we're currently doing. And we can take a lot of different projects into consideration under our light refurb. So essentially, if you're doing any works to the security that don't require planning, can be done under PD, that falls within what we classify as being our light refurb. So that could be new kitchen, new bathroom, lighting, heating, all the usual things you would do if you'd gone to auction and bought a rundown property and you want to kind of gut it, renew it, and as I say, either sell it or retain it. We can accept small extensions, as I say, anything that can be done under PD. It's the planning piece that changes it within our model from being a light refurbishment to a heavy refurbishment. But sticking with the light at the moment, so where we do this 80% net day one, what we're looking for to be able to be comfortable lending that as a bank is for you to increase the value of the security. So at the end of the transaction, we're sitting at 75% against the uplifted value. So then that allows us to be able to roll the interest, roll the fees, so that as long as there's enough upward lift in the security value to come out of the transaction at 75, that's why we're comfortable lending the 80% upfront. And it could be a project that you enter into on a JV basis. So maybe you have the experience, but you've got an investor that wants to put in the money towards the deposit and also to cover the cost of works as well. So have any of you done any of these kind of projects recently, or just to give me a little bit of a feel for the experience you guys have got, or is this something that you're looking to get into at the moment? No, that's fine. I shall keep talking.
I've done.
Oh, hold on.
I've done
Sorry.
a
Go on.
couple. Yeah, I've done a couple of bridging sort of development type projects, like what you're talking about now. Yeah.
Okay, perfect. And did you obtain like finance from a lender to support the project?
Yes, I did. So I used a second charge as well, just to increase that amount. And it
Okay.
was for the development as well. So yeah, I've had two experiences of two different lenders, and yeah, they've both been different. But yeah, it's good that you offer the 80%. So yeah.
Yeah, no, that's fantastic and good to hear that you've had some successful projects. But yes, the beauty of this product is the fact, as I say, we are giving you that higher amount out there day one. What we found is recently an awful lot of people have been looking to get into investments. They want to become landlords. But just the way the market is at the moment, single properties are not as high yielding as, for example, a small HMO. So probably about 70% of the business that we're writing on this light refurb product at the moment is where people are purchasing a single dwelling and they are turning it into a small HMO up to 6 beds, which means they can then retain that as an investment. But as an HMO, it's generating a higher yield. And for us as a lender, because it's only a small HMO, again, we don't need you guys to have had experience in doing that previously. And with the small HMOs, most councils will allow them to be done either under PD, so you don't have to go down the road of getting planning in place. If you did want to move on to a larger project that required planning, we can still cover that, but it just means that we are looking for a little bit more experience. So you would have needed to have completed at least a couple of other projects previously to then give you the tools that equip you to doing something a little heavier. And obviously engaging with the council is probably never an easy task when you're trying to put through a planning application.
Can I just interject?
Of course
on
you
that
can.
one? So I've actually got myself personally a case in with Castle Trust I'm going to complete on in the next week on one of these 80% bridge products. And in my scenario, it was a probate property. I've got it a bit under value. I'm going to be spending about £100,000, which will give it the GD uplift. And for me, because I've got a few bits on the go, having this product meant I didn't have to put so much in day one, and I would have the funding for me to do what I needed to do on it. So this Castle Trust product was, perfect for me in that scenario. And again, the extension that I'm going to do is under PD, and I've actually got an architect, and I'm working with the architect who also confirmed with the bank about what we're getting up to, meant they were comfortable with the project. And so we're going to be getting started on that. So that's quite exciting for me. And yeah, so there you go.
Yeah.
Little case study.
I know.
Did you have your hand up, Claire, for a while? Did you want to ask something?
It was only just to say I'm complete newbie, so I was just looking at just from the other end of the perspective, really, of what's available to newbies as well.
Oh, so what I would say is, when we do these webinars, we're bringing on various different providers and banks and lenders. And obviously, these banks and lenders each have their own USP. So don't panic that you may be a newbie and what Sammy has said meant you wouldn't qualify for one of their products. We will have plenty of other lenders who can assist newbies. Okay, so some of this might not be relevant for you, but don't panic. We've got a large array of lenders, and as we move through the weeks, every couple of weeks we're going to do one of these webinars, of which we're going to have our select partners come on, and each one of them operate in a certain market space. But what I can tell you is there definitely be opportunities for you, because different lenders have different risk appetites. So whereas potentially the way Castle Trust is geared up, they don't want a newbie on a big development project. There will be other lenders who do, but at the same time, there are other products that will be available to you with Castle Trust, but it was just more on the development side.
Yeah. So the light refurb will be perfect for you because you can do that as a first project. If you don't own any other assets, we would just need for you to put that into an SPV. But if you're already a homeowner yourself, then you can do that as an individual. But I'm sure that again is probably something you would talk through with Sean, the best way to kind of structure it. But in terms of actually lending to you for your first project, that is absolutely something that we could accommodate for you. And the other thing that we're very good at is being able to, okay, we're going to do the front end project. You're going to do the works to the security. You're going to uplift the value. And if you're looking to retain that as a property to start your own portfolio, right at the very end, we can consider being the exit and allowing you to refinance and hold it as a term buy-to-let security. Okay.
Cool, thank you.
I think Nicotarios has got his hand up, wants to ask something.
Yeah. Hi, Sammy.
Hiya.
Are there any minimums? Are there any minimums on the amount that we can borrow?
There are. So we do have a minimum loan size of 200k, although we don't have a minimum property value. So you could do two smaller value properties under one transaction.
Okay.
The
yeah.
minimum loan is 200,000.
Is that including the development then? Yes, not just the purchase, or is that the purchase?
Correct, just for the purchase. So we
Just
will
the
be looking,
purchase.
yeah. So
Yeah.
on our 80% product, we'd be looking at minimum purchase price 250, which then will give us our minimum loan of 200k.
And
Right.
again, what I
Okay.
would say is, Castle Trust is just one of the lenders that we have access to. And when you hit their demographic, they're very good at what you're looking for. They're one of the top firms within certain demographics. But don't worry, again, as I said, mentioned to Claire, when we go through other webinars, if you're looking at more, I'm only looking at 100k property to purchase, we've got a different range of lenders to help you on that project. So don't get too concerned about that. But this is something where they've got a minimum lend of 200k. But if you do hit that, they are market leading at what they do.
Yeah. And we can consider lending on a whole different range of residential securities. So that could be anything from a single dwelling. I've already mentioned small HMOs. But we do large HMOs as well, and multi-unit blocks. So it might be you can purchase a security at auction that under PD you could then convert into 2 flats. Again, automatically, you're increasing the yield for that property and making it a more attractive investment to hold long term. Okay, so on the light, as I say, everything that can be done without the requirement for any planning. And then sitting next to that, we've got a heavy refurbishment product, which again allows for 80% net out of the security value day one. But it allows for works that do require planning. So if you wanted to do a small extension, then that needed to have planning permission, that would then sit on this heavy product. But neither of those products, because they're giving 80% against the property value day one, then allow for further borrowing out towards the cost of works. And that's when we have a third product that comes into play that kind of is a little bit of the best of both worlds. But everything that we're doing on the light and the heavy, as I say, we're looking for that upward increase in value. to make sure we're sitting at 75% at the end. But on a heavier project where we're actually lending towards the acquisition and then for funding out towards the cost of the works, that one we're netting at 75% day one and looking for a high enough uplift in the value to come out of the transaction at 70% at the end of the term.
Can I just stop you there? I know you're in your flow, so stop interrupting me. It's annoying. What I wanted to say was on this development project, again, it's a bit market leading because a lot of the lenders, although there's many development product lenders out there who do 100% drawdown for all the works, their day one can range from 60 to 70% net. So for Castle Trust to give 75%, that 5% can make all the difference when you're trying to sort of get a project off the ground, you know, that the deposit, and then you've got to show you've got the funds just to get the project started. Because when we talk about 100% funding on drawdown, it's done in arrears. So I'll break that down very simply. Say that you needed £100,000 to do the development works. The simplest way of doing this is it's done in 4 tranches, and each tranche being 25,000. You would potentially need to demonstrate you also had the first 25,000 to pay for everything. It then gets inspected. They look at receipts. Different lenders may use a quantity surveyor or a land agent to come to the property to inspect you've done what you've said you've done. And then a week later, the funds are released and you get that first tranche. So because of, you know, typically people see a project, and everybody, as you well know in life, pushes themselves to really, you know, the maximum. It's these 5% that can make a difference between getting a project, you know, on or off the ground and ease that pressure that you may see on that project. Sorry, you can carry on now.
That's fine. So on this drawdown product, as Sean said, this is where we are lending 75% net against the asset value day one, but it's a far bigger project, so you're going to need some cash injection or some help from us as a bank to actually fund those works. So typically we would be looking at a scenario maybe where a really good example actually is one that we've got on the books at the moment, which was a former pub which has got planning in place to convert to 3 terraced houses. So simply put, the building structure is already there. All of the utilities are already connected, but that one security is now going into 3 terraced houses. So for that, we're going to lend 75% out against the value of the property as it is now. And then they also needed a further 600,000 in arrears to be able to complete all of those houses. And at the end of the project, they're going to retain them within their portfolio. So that's very typical of the type of deal that we would see. Something like that, you are going to need to have experience. Even if you've done one other project previously, and this is much larger than you have done in the past, we can always look if you're partnering up with a very experienced architect, as Sean said, or a contractor, and if they can demonstrate by their website that they've done similar projects in the past and they've got the relevant experience. If you don't have it yourselves, we can look at that to kind of get us where we need to be. And I would say as a bank, we are very much looking to work with you wherever possible. So you don't have the experience, has your team got the experience, that kind of thing. And this is where the partnership between ourselves and Sean as your broker, he really will know what we do inside out and be able to work with you to make sure what's presented to us is actually going to work for us as a bank. Now, that project I've just mentioned, that did require planning to go from pub as it was to the 3 terraced houses. We can only lend on residential security, or obviously that was a commercial asset to start with. But because the planning has already been granted, we're happy to lend on it as is with that planning in place for the works to then be able to continue. If you've got something that needs planning and is currently residential, but is going to another residential use, say, for example, briefly mentioned, you've got a single dwelling and it's going to turn into, say, 4 apartments or 4 flats or even holiday lets. It needs planning for that change of use, but because the current use is residential and it's going to a different type of residential, what we can offer is like an interim product to allow you time to get that plan in place, and then look to place it onto one of our development loans to actually then lend the works once that planning is approved to get those works underway.
What I would say is this is why it's imperative to work with a good broker. And when I talk about that, you know, we have clients say to us, oh, my last broker or the other broker doesn't want all this information that you want. And the reason we want so much information is we pre-package and underwrite the case before we even go to the bank or lender, which means when I go to Sammy with these deals, and some of what we do is putting square pegs in round holes, it's all about the presentation. And if you understand the client and the deal inside out, you're then able to potentially look at a scenario or option or a workaround when a case doesn't quite fit. And this is imperative for you to work with us, and why we want so much information. So we know every detail, so we've got the best chance possible of success with the best lender possible. And this is why we are so successful at what we do, and why we're able to take so many clients where they've failed elsewhere or failed with another broker with a bank, that we ultimately go to the same bank with, but present it better, and it goes from a decline to an accept.
And that is the key thing to it. It's all about the presentation. So Sean will have an initial conversation with me, float an idea, say, look, what do you think of this? And then we'll talk together, we'll work it out. And if we can't quite position it as it's been presented, then we'll try and find a way that does make it work for yourselves and for us as a lender. Because we put so much into the key things for us when we're looking at whether or not we're going to lend to a client, we're really looking at the security. So that for us has to be ticking our boxes. It might have some quirks to it that we can kind of iron out, but we're not going to go to the ins and outs and background so much of you guys, because ultimately it's the security that we're interested in. So it might be that obviously for Sean to do what he needs to do, he needs a lot of background information and a lot of supporting documentation from you. We don't necessarily need that as a bank, but then that means Sean is in the best position to then be able to go to any lender that suits your circumstances, knowing that he's already got everything that he needs. So from a time frame point of view, it means as it is presented to us, because the background checks have already been done, if you've got something that's very urgent, like an auction purchase, for example, that's time sensitive, we're in a good position to get that application underway and ensure we hit that deadline for you. We work with some really good solicitor partners that can offer things like dual representation and also title insurance, which can speed up the whole transaction. And I know Sean can probably recommend some very good solicitors to kind of benefit and act on your behalf. Sorry, any questions before we kind of move on to the other phase of lending that we do?
Sammy, sorry, I'm not competent enough to put my hand up, so I just interject again.
Well, you can't, if you don't put your hand up, you can't say anything, so sorry.
Well, I need a lesson from Claire and Notarius. Look, he's put his hand up just to shame me. Do you deal with expats?
We do.
I've
Funny
just
you should
learnt
say
that as well.
Yes, we
just to make
do.
you feel better.
So we can consider lending to expats and foreign nationals, both foreign nationals residing in the UK and outside of the UK.
But not Turks and Caicos.
Yeah, and obviously the more high risk the jurisdiction where you're residing, it just means we'll have a few extra layers of due diligence and compliance that we have to follow. But it's absolutely not a no, especially if you've already got a UK mortgage footprint here, so you've got a established security base in the UK.
Okay, perfect. Thank you so much.
Oh, and Karen,
Yeah.
what's the number one rule I told you about property moving forwards?
Buy in England.
Thank you.
I've looked
Yeah.
at Wales, Sean. I can't lie. I'm sorry.
We do lend in England and Wales, so Wales is fine as far as I'm concerned.
Thank you, Sammy. Sean is trying to brainwash me, just England. Thank
But,
you.
Nick Torres, did you have a question?
Yeah, you may have answered it, but is my understanding correct that the 200 minimum still applies for that second product, the 75% net on the purchase?
It is, yes.
Yeah,
So
and
even though it's a minimum loan day one of 200, and then we can consider up to £1 million out towards the cost of the works if the project requires it.
yeah, and then just another thing I've come across with some lenders, you know, if you buy a property for, say, below what the market rate is, I'm just giving an example. Just say you buy
Mhm.
something for 50, but you know that a lot of the properties, similar ones, are at 70, for example.
Mhm.
When it comes to the valuation, they normally just give you that 50, even though it's worth set. They don't give you the benefit of that 20. Whereas, just say it was below, the other way around. Just say you'd purchased it for 70, but it was only worth 50. Then they only lend you on the lower amount. Does that make sense? Does that apply to yourselves as well, or?
It does make sense. So we've got a couple of different ways that we can look at it, and unfortunately, it will lend one way, but it's always going to be down to what the valuer says and what the valuation comes back at. So,
Yes.
for example, if the market value of the security was, say, 300,000, but you had secured to purchase it at 250,000,
Mm-hmm.
on our refurbishment products, we can lend 90% of the purchase price as a below market transaction. So rather than doing 80% of the open market value, 300, we could potentially do 90% of the 250. But that needs to be confirmed by the valuer.
Yeah.
Ordinarily,
So it's the value rather than the purchase price. Yes.
yes.
Yeah, because I've had a case where the value has been, the purchase was 50, and he's just marked it as 50 because, you know, I don't know, just to be safe, even though I well knew that, you know, the property was worth, you know, 65, 70 minimum. So yeah,
Yeah,
so it goes.
but I
Yeah.
do think that is a different type of market, and there is an air of caution in that
Mhm.
because it is at that sort of lower end, and
Yes.
you know there is some mechanisms there. So I would say I wouldn't use that as the norm. You were in a bit of a specialist niche area there at that lower end,
Hmm.
and as such, there's not the degree of wiggle room or interpretation, or it's a bit more of a limited market.
Yep. Okay. No, thanks for that.
That's
Thank you.
okay. So yeah, I mean, that's a good point to make. We can look at some undervalued transactions, but as I say, it always needs to be supported by the valuer, and our lend at the end of the day will be ultimately based on what the valuation has come back at.
And listen, if we did have something marginal, the bank does take a view. So although it's got the minimum 200k rule, if it was presented to the bank and it was all accepted, and then we'd gone down that path of valuation and things went a bit sideways and we missed it, and it was out by 10 or 20k as an example, the bank would say, listen, we've already done all the work, we've accepted it, so the chances are they're still going to follow through on that.
Yes, yeah, we're not necessarily going to pull the transaction because we're suddenly below 200k. If at the start of the transaction everyone believed we'd be the other side of 200k, so exactly what Sean said. What we are finding, funnily enough, as you mentioned, Wales, Karen, is that a lot of people are not only kind of diversifying into these HMO multi-unit properties, but also into holiday lets as well, because generally speaking, they can generate a lot higher income than a single property on an AST, for example. And that is something that we can consider as part of this refurbishment program. So if you wanted to buy a security and actually refurbish it to hold as a holiday let, we can accommodate that. But what we're looking for is for the planning use on the security to remain as being residential. So if at any time in the future it needed to be let on an AST, for example, there would be nothing in planning to stop that from happening. And we have a very, very simple process of looking at what the income generated by that security would be. So we can allow you to speak to a specialist agent like Sykes Cottages, for example, and we can utilise the high, medium and low seasonal income figure to support the security post refurb if you're then looking to hold it as a long-term investment. So that is another area it's always good to look at to see if you can diversify your portfolio into. Again, we don't need experience for that. So if you don't hold any properties, we can still consider lending to a first-time landlord that wants to hold a holiday let or an HMO, not restricting you to kind of simple single dwellings. So once we've kind of had the refurbishment program on the books and it's all gone to plan and everything's ready for the tenants to move in, you're then at the point where if you're looking to hold it as an investment, we as a bank can then refinance our own transactions and actually hold them as long-term buy-to-let deals. So it doesn't mean to say that you're tied to us to hold that security with us, because Sean will know there are other options available out there to provide you with as your exit. But if it does work for us and you want to stay with us, then that's absolutely an option. And we can do standalone buy-to-let. So we're not only looking at buy-to-let lending off the back of our refurbishment loans, we can do them as standalone. And as I mentioned, can do that for first-time buyer, first-time landlords, also for expats and also for foreign nationals, some of whom will be residing outside of the UK and potentially the EU. So what we're looking for on a buy-to-let typically is, again, this is not based on your kind of background and earnings. The security will just need to support itself. So we need to see that there's enough rental income coming through, so it will cover the repayment on our loan, typically either by 125%, 145 or 165, depending on how you're going to let that security. If you're just going to let it to a single tenant on an AST and it's in an SPV, very straightforward, 125% coverage. But something a bit more complex, like a holiday let, where we're going off to these agents and asking them to provide us with the high, medium and low seasonal income, that's where we're looking for a higher coverage of 165%. But again, Sean has all our product details, so they can work out the numbers before it comes over to me.
So I just wanted to tell you some stuff we're actually doing with Castle Trust for other people. One of them, via a bridge, we're buying 3 flats at once in the same building off a client, and one that had been repossessed off the bank. So within that structure of the freehold, Castle Trust are happy to take on 4 separate securities. And you will find with some of the more vanilla lenders or other lenders, they will have a maximum appetite of 2 or 3. So Castle Trust are very good in that scenario. And at the same time, because we do a lot for clients where we're doing multiple deals at once, we've got one site where we're doing in effect a couple of bridges bolted together, because we're doing 3 for the 3 flats and then 1 off the receivers. He's then got another block of 6, and Castle Trust are doing all 6 within that block and the other 4, so that's 10, all at the same time for the same client. So again, this is, this sort of thing isn't for every lender, and this is where Castle Trust has got the capacity to sort of take on these projects where other lenders can't. And what they've also, I should mention, so we've talked about the 200k rule. In one of these blocks, the block of 6, it's in Wales, and those units are only 75k. So you're going to say, hold on a minute, it's only 75k value, and you've got the 200k rule. So what we've been able to do is bolt flat 1, flat 2, flat 3, flat 4, flat 5, flat 6 as one, to then get over the 200%, 200 minimum K lend rule. So again, it's out the box thinking, and it's coming to myself or a broker with this is what I'd like to do, and thinking for these out the box thinking solutions, so then present it to that lender. And a lot of what we do before we submit it, we've already sent it into them, so we've already got an accept of in theory, subject to you fully submitting, we're going to do this deal. So rather than put the deal on and get rejected, we've put it in before putting it in, get it accepted, and then put it in, because it's just going to go straight through. Does that make sense? Bit of double
It does make
paradox
sense.
there.
So, yeah, we have many conversations about cases before they actually come through. So what that means is at the point at which it lands and it goes to one of our underwriters for approval, we've done a lot of the background checks already. We've worked out all the quirky bits, made sure that we're happy with it. We can engage with our second line credit. We can engage with solicitors to make sure when the transaction comes to go through, we've kind of covered all these unusual events to make sure that we're absolutely happy with it. And as a bank, we are funded by our own investors, so we're a very safe bet in terms of lending. So you wouldn't need to worry that you do hear stories of some lenders with funding lines that suddenly get pulled overnight and potentially could leave you in a situation where you're then trying to replace that with another lender. But because we're a bank and it's our own funds that we're lending, we are very safe to ensure that if we say we're going to do something, then we will do it, and can't guarantee you'll get the money, because obviously everything has to go through its process, but it's pretty darn sure that you will actually get the funds at the end of the transaction. And Sean has access to everybody that he needs to. So he's got myself as the main support for his business, but then commercial director, managing director, second line risk, they're all available for calls and discussions should cases become slightly more complex than we realised from the outset. And we'll work with Sean to obviously make sure that we get an outcome that works for everybody. Okay, so I started to talk very briefly about the buy-to-let proposition. So this is where we're kind of a little bit more in line with the rest of the market in terms of the lend that we do will be at 75% LTV as a max, which is pretty much the norm for buy-to-lets out there. Again, minimum loan size is 200k, but we could go up to 5-10 million if needed. And we'll do anything from a single dwelling to small HMO, large HMO, multi-unit purpose blocks, which is very much like the transaction Sean was just talking about. So it could be 4 flats under one title, and we can lend on the whole block, or it could be 30 flats under one title and we can lend on the whole block. We can also do portfolios, so it might not be securities within a block, but you might have 3 or 4 that are already owned within a portfolio, and we can just refinance that as a whole as one transaction. Or you might be lucky enough to go to auction and actually purchase a portfolio. Again, we can help support you doing that. So we'll get the individual values of the properties, but we'll do it as a combined loan across all of the security values together, and we can utilize the rent from all of the properties. So it might be you've got some properties that are high yielding, some are lower yielding. And if you took them in isolation, maybe they wouldn't work standalone, but when they're grouped together with the other securities, we can then make the whole deal work. We lend in England and we lend in Wales. We're not lending in Scotland at the moment. And we can lend not only to sort of individuals, foreign nationals and expats, but SPVs and trading limited companies too. And we have no minimum time trading for SPVs and limited companies. So it could be a brand new startup or to add into an existing company that's already got some securities within its portfolio. And something else that is quite quirky and unusual, and not a lot of other lenders will do it, rather than just allowing you to acquire security, if you're in a position where someone owns a property within a limited company and they're actually selling the company with the property within it, we can actually look to support the transaction to buy the limited company that contains those securities. Sorry, Nectarius, you have a question?
Yeah, it's just touching on what Sean said about combining properties to reach that 200. Is that purely on blocks like apartments? Or can it be two unrelated? Could it be two terraced houses or three?
Yeah.
Or yeah?
Yeah, I
Okay.
mean, I think every deal has its merits, and it's really looking at that and saying, if we, bolt these together or do it this way, is that right for the lender, i.e. Castle Trust, or actually it's not a Castle Trust deal, it's a deal for, I don't know, Hampshire Trust. Sorry, I shouldn't say that word, Hampshire Trust Bank. Sammy used to work for HTB. But so all I'm saying is, listen, one shoe doesn't fit all, but at the same time, if it's the right product for you, and by doing so, we're bolting two separate entities together to get it to fit for Castle Trust, that's definitely something we can look at. It's really engaging with ourselves or the broker that you want to use to make sure he understands it. Goes back to KYC, know your
Yes.
client, so he's understanding your drivers and your motives for what you want as an end result. And everybody's drivers and motives are different. So as much as you could argue that, everyone's motive is best rates, a lot of the time best rate doesn't equate to best deal, because if we drill down with you as the client, it could turn up that, yes, I want best rate, but I want it done in 3 weeks. Well, best rate doesn't give you 3 weeks completion. Or I want best rate, but I want highest loan to value. So again, it's the best rate for that highest loan to value, but not the best rate on the marketplace. So it's really drilling down with you as the client of, well, yes, of course, everybody wants best rate, but what is it you need? What is your driver? What is behind this this sort of transaction, so to speak? What do we need to do to give you what you need? And that's really, really important. And a lot of people come to us where they've failed with other brokers because they've not gone through this process. And one of the things that we're seeing more and more over is valuations. And why I'm harping on about this, and I do in the group, is a lot of the specialist market, let's say we split the specialist market down the middle, 50-50, and that's bridging that specialist buy to let. Half of them will do their valuations and lend against full market value, and the other half will lend against 180-day value. And the 180-day, so full market values here, 180-day values here. And then if you're lending off this lower launch point at 75%, the 75% you're at with this potential lender at best rate at 180 days is not the same loan to value as a lender who's lending off full market value, but they may be the best rate full market value lender. So, it's really engaging with you as the client so that we understand you, but you understand us and where we're coming from as well.
Definitely. So yeah,
Yeah, makes sense.
absolutely.
Thanks for that.
We can look to lend against 2 or 3 securities, not within the same block. And usually it might be that we get 3 houses that are all on one title, which we can consider. We don't ask for the titles to be split. So when it comes to securities and making a deal work, that's where we can have these conversations and try and build something that will work for you. So we're absolutely more on the specialist side than we are being towards a kind of high street bank type lender. We have 5-year fixed rate products, and we have a 10-year term, which normally suits most people. So it does mean you know exactly where you are for the next 5 years. In terms of the rate that you have with us, everything is fixed. We haven't got any sort of variable or tracker rates. But again, if we don't have something that suits you, that's when Sean will say, works with Castle Trust, but actually we may have better lender options out there for you as well.
Yeah, and they're not going to get offended because we're engaging with them on a daily basis, and at the end of the day they want a deal that's not only right for you but right for them. And it may be, once we've engaged in this process, that for whatever reason this deal isn't right for Castle Trust, but then we'll understand why it isn't right for Castle Trust, which will mean then we'll understand where we need to put it. So we could, when we look at all these deals, it's a bit like everything in life. You've got 1, 2, 3 and 4, and you go, right, I think the best one is going to be for this Castle Trust. And then, oh, you don't like it. Well, what was the real reason you didn't like it? And you go, well, I know that my number 2 or number 3 lender doesn't have an issue with that, so we'll pump it over to them.
Yeah, absolutely. So that probably pretty much covers what we do and what we can support you with. So anything from a very light touch refurb, your heavier projects, and then, as I say, a retention product if you want to hold the investment long term, or just go straight to holding the investment without doing any refurbishment works to the securities. All different types of residential properties that we'll lend on: the single dwellings, the holiday lets, the HMOs and multi-unit blocks, and all manner of property developer types and borrower types that we can lend to. So hopefully there's been something in there that either you think will help you for your next project, or is giving you some ideas of where you can kind of go out to market and identify different types of investment properties that suit you. But if you do have any questions, I am around for a little while. Sean, I don't know if there's anything you kind of
I just wanted to sort of add the bolt-on partners. And this is very important for you to understand when dealing with Castle Trust or similar lenders. So first off, valuations. Valuations with Castle Trust currently are done with a specialist panel valuer called VAS, and they work with the majority of all the lenders. And what will happen is you'll get to a stage at valuation, and they will panel out your property in question for valuation. And what will happen is 3 or 4 valuer companies will come back to Castle Trust, and they will give a various line of options, and they say, we can do it in 10 days, and it'll take us 5 days to do the report, and we're going to charge 1,500 quid. And then option 2 will say, we can get round in 2 days and we can turn it around in a day, but we're going to charge £2,000. And then option 3 and option 4, so forth. So then you've got this matrix of options on valuation, and you can make an informed decision what suits you best. And if you're in no rush, maybe you'll go for price, or it may be that valuer firms are only 2 miles away from your property. So that's number 1. Number 2 are solicitors, and this is where we see sometimes the clients, like yourselves, have put what we call the cart before the horse, and you go, oh, I've instructed my solicitor, they've already started work, this is the solicitor I'm going to use, and all of a sudden we grind to a halt because you haven't realized that in the specialist market you typically need a minimum, and some want 3, a 2 SRA practice management firm, and this is a solicitor regulatory authority, and this is key. And this is why we also like to make sure we're steering you on this, to not only make sure they are fitting the criteria of a 2 SRA minimum firm, but a firm that understands the lender, because all the lenders have got the quirks, and there's no point in finding a firm or a 2 SRA firm and they've only done 1 deal in 18 months with Castle Trust, because I'll tell you what's going to happen. It's going to just grind gears. So what we want to do is, it's not about costing you more money unnecessarily, or you think, oh, we're recommending that firm because we're in leagues with them to make money off it. That's not the case at all. It's making the process as frictionless as possible, making you've got compatibility, and making sure it can complete as easy as possible and as quickly as possible. So, not just dealing with us or dealing with anything, it's more a case of make sure before you instruct a solicitor and a value and everything else, that solicitor is compatible with that bank and they've, ask them what their experience is. So don't be afraid to go, right, I want to do bridging. How much bridging do you do a month? How many times have you dealt with this lender? Who do you deal with at that lender? What do you know? Fact check. Are they really specialists in this area? And is that going to correlate with what you're looking for? And that's very important. And some people miss that detail. And as I bang on about it in my group, cheap doesn't always equate to best. These are the most expensive purchases of your life. And you've got to spend perhaps a bit more money than what you might have thought you had to get the best result. And sometimes that can actually save you money. And what's really important is we've had some people who've gone another way, especially at auction, and they've had problems because they haven't had the right partners in place, and that has ultimately cost them a lot more money in the long run.
Definitely, I would.
Has everyone fallen asleep now?
I would echo, it's really, really important. You need all the right people around you. Valuers, we do give you a choice of 3 or 4. And also the solicitor partners, they need to understand us as a bank. They need to understand what documents are going to be coming their way that we're going to have returned to us. So therefore, using someone that's experienced, or taking advantage of our dual rep facility where our solicitors can also act for you as well, can ultimately save a lot of time and money in the long run. So yeah.
And I've dropped them in the group recently, and we send them as part of our engagement emails. We've actually got sheets on about valuation and solicitors to give you that guidance. Also, the journey of these projects. So no matter which advisor you get, you'll get their advisor profile, you'll get why you've got this advisor, their experience, and also the journey from day one all the way through the process, plus the solicitor pack, plus the valuation pack. So we're really trying to give you as much information as possible. And what I can tell you, you're not going to get this typically at other brokers.
No, absolutely not.
Oh, are you waving your hand there, Evie? See, another one can do it, Karen. Just saying.
I was just asking a question about the valuations. I've just literally, I was going to come to SBL to do a bridge because mine wasn't going like as planned, but it did end up going as planned. The valuations all came back in, everything was okay. So I've got 4 properties now, and they've only just recently been valued. So I got them round about 35% below market value on all properties. All the valuations came in at the top end price for them without any like renovations on them or anything. I'm thinking of doing so for instance, I've bought 4 properties, £370,000, and the valuations all come back at £590,000. So I've got £220,000 in equity if I was to buy to let, So I was wondering, are those valuations still okay because they were only done in the last 4 weeks? Do you know if I was to come to yourself to buy to let to do
potentially? So 2 options
Yeah,
are available here. Depending who they were done by will depend if the lender will accept them, and that we got the potential option to do a retype on that lender's template. So you can't use them per se.
Yeah.
But what we can do potentially is send them in, and they just get retyped, and that's done at a reduced cost.
Okay, that's fine.
So for whatever reason is, those valuations will be done for XYZ lender, and we're saying, right, we're going to a day one lender.
Yeah.
They've seen these valuations and they will lend 75% on these values.
Okay.
However, we've got to go back to that value to say, right, how much for a retype? And that could be, if you were talking about a full valuation, that could be £1,000, and the retype could be anywhere from 400 to 500, half price, but they won't typically have to go out to the property and all that.
Yeah, these were done desktop and everything else. So, and they were VAS as well. Well, then I'm wondering...
there's a good chance. So, as I say, I know Louisa at VAS personally. She's the director. I've done some podcasts and that with her. So we've got a very good relationship with VAS. So it's definitely something I can get looked at.
Yeah.
Super. So there's
sure.
another question then. I've got like a bridge on it at the moment. It's like a first charge on the properties and a second charge on my property.
So you've got a cross charge
Cross
bridge.
collateral, yeah.
And who's
so
that with, please? Is
it's
it like
Hope.
MT or someone?
Hope.
Hope. I know Hope Capital very well.
Yeah.
I've been on the phone to them several times this morning and their underwriting team.
Right. Yeah. They've been really, really good. Don't get me wrong, you know. So yeah, that's good. So if I've got a bridge with them and I want to do a BTL to get out of it, I have got no exit fees. However, I've got a 3-month clause that I need, you know, for the interest.
Yes.
Am I able to do BTLs before that is up and then just
Yeah, so what you do is I know what you're
saying.
saying. So you do that, we're doing it now, get the offer, get it ready to the point of completion, and then delay it by 4 weeks until you're out of the 3-month clause.
Yeah, okay, so I can do that.
Yeah.
So it's about getting all our ducks in a row, liaising with solicitors, liaising with Hope. Obviously, that's easy for me.
Okay.
So we do it bang as soon as you're out of your.
You sent me an engagement letter, an introduction, and everything. So I'll fill all that in and send that back to you, and I can get rolling with something like that.
Definitely, we can do that. Yeah.
Okay, super.
So when you send that back, can you send me please all the valuations so I can look at it?
Yeah, of course I can. Yeah. So what I'm going to do now is I'm going to have to jump off because I've got a 1-to-1 with Beth at 3:00 and she doesn't like being late. But yeah, that's great. I'm glad I got my question in and everything. And thank you so much. You know, and I'll join your next webinars as well. Thank you. And I'll speak to you.
Thank you, Evie.
Thank you. Bye-bye.
Okay. I think we're kind of.
Yeah, I think we're in. So does anyone else have any sort of questions before we close it off today?
No. Thanks very much, Sean. And
That's right.
Sammy, thanks very much.
We've got a couple of hands up again. Sorry, it's coming up as DLC. I'm sure that's not your name.
No, hi. No, George Delacour. So the DLCs from
George.
The initials.
Oh, right.
Okay.
Hi, George.
Hi. Yeah. Sorry, I was late to the meeting. I had a few Wi-Fi problems here in Panama. First world problems, right?
Yeah.
So, thank you very much for the session.
You're up there with Karen, who can't shake a hand.
So I don't want to go off topic, and I don't know if this has been included, but one of the things that I've got a JV partner, John Ennis, who I think may have spoken with you earlier. But one of the things I'm looking to do through my company moving forward is buy or lease to buy deals. And I'm just wondering if you guys are able to offer financial solutions for those.
Probably not something that we can offer a solution to, but maybe something in your wider panel of
I would
lenders.
have to sort of understand the lease and the deal to get my head around it. And I may have a firm more suitable for that type of thing.
Right.
So
okay.
So
I'll
I would
be in
say
touch as and when
email me the structure of the deal, all the ins and outs and the dirty bits of it, so I can get my head around it, so I can present that properly and see what the appetite in the market is for that.
Sure. Okay, great. Thanks very much.
That's right.
No problem.
Oh, Claire?
Yes, it was just on the back of Evie's question, actually. She mentioned about the cross-charge bridging. Is that something that Castle do at all? And does that change the net lending?
So yes and no, but the only time we'll do a cross charge is because we're only doing unregulated lending. It would have to be first charge on the security that you're acquiring and a second charge on an investment property that you already own within the same entity. But again, whilst we can facilitate the first charge, Sean may be able to look at doing a second charge via another lender. And we're happy that that's happening in the background. So we can facilitate it, but just not all together.
So let me break that down. The industry is split between what is called regulated and unregulated. And if you live in a property or you have lived in a property, that is defined as regulated. Okay. When we talk about investment, buy to let, commercial, all this other type of business, that's the unregulated market. Now, there are a couple of instances, a small percentage, where these two entities merge. Now, what I would say is, again, you have most lenders keep in their lane. You have the regulated lenders and they're in that lane, and then you have the unregulated lenders and they're in that lane, and they don't mix. They're in their lanes. That being said, there are, let's say, 10 or 15 specialist lenders that are able to cross lanes, okay? And they're able to do simultaneous regulated and unregulated and cross that. But again, it's a bit more specialist. We're able to do that because as much as we're a specialist brokerage, and many specialist brokerages, most of these specialist brokerages are unregulated, we are actually specialist regulated and NFC accredited, so we can do the cross mix as well as regulated and unregulated.
Yeah, I think I got that.
Hopefully that wasn't too complicated.
Sort of similar, but if you can you use your residential property as the security for your loaning as well?
Most definitely. So we also have the beauty, I don't know if you can see that up there, of RAM secured loans. And these are second charge secured loans that we do. Probably our average secured loan is probably pushing 100k, but it can be as low as 15 and go all the way up. I think the biggest one I've done is about 300k. And we're doing, I don't know, 10, 15 of those a month. And what that does is it allows you to access the equity in your residential property and use that for business purposes. Now, what I would say is it is a income assessment based affordability, but it is typically more generous and flexible than your first charge mortgage. So I'll break that down again. Let's just say you've got a property worth 400k and you've got a mortgage with Halifax or Nationwide, whoever that may be, for 200k. So you've got this 200k equity. And what you'd like to do is you'd like to access 100k to use as a deposit for your next buy to let, or deposit and refurb money for your next buy to let and bolt that onto a bridge. I'm using that as a hypothetical example. The secured loan just sits on top of your mortgage, which you don't want to upset because it's a 5-year deal and you're 2 years in, it's a low rate compared to the current rates of today, and you'd have an early repayment charge. So you sit this secured loan on top, which is for 100k, doesn't interfere with the mortgage, so you continue paying your mortgage and the new second charge. And then when your first charge, for argument's sake, comes up for remortgage with no penalties and everything, you could potentially remortgage all as one. But what that does, it accesses the security, let's say 100,000. You've seen this property at auction. You're going to use £50,000 worth of that money as a deposit with a 100k bridge. And then it leaves you 50k to do the refurbishment work of that property that you've bought the bridge with. And then when that work's done, you will have the uplift in value. You'll potentially get your buy-to-let mortgage, and then you can clear, if not all of it, the majority of the second charge loan. And then you've got money again to potentially go and look at doing the next one.
And is that different from putting a bridge on?
Yes, most definitely. So a cross-charge collateral bridge, that goes on top of your mortgage, but typically capped at 65% loan to value. And also you don't make any payments. So it's more bricks and mortar assessed rather than income assessed. But what I would also say to you, it is deemed as more high risk. And the reason I say high risk, it is a short-term loan. And bridging is typically 12 months. And you're securitizing a cross-charge, a short-term loan on your residential where you live. And if you don't pay that back within the 12 months, they're coming for your residence. That's the harsh reality of it. Whereas a secured loan, it's like a mortgage. It's like 20 years, 25 years, although you're not going to have it that long, you're not under that time pressure. So all I'm saying is, yes, cross collateralization is good. It can be a good idea, but it's imperative you've got a robust exit strategy and you're aware of the risks and that it's a higher risk strategy. Okay.
That's great. Thank you.
Perfect.
Any more for any more? No, I think
Great.
that's it.
Wonderful.
Well, listen, thank you for your time today. We're going to make the recording available to you and we'll send that out at a later date. And we look forward to seeing you on the next webinar. Thank you for your time today.
Thanks for joining, everyone. Lovely to meet you all.
Thanks, guys.
Thank you. Thank you.
Thank you.
Thanks.
Thank you.
Oh, and that's saved. That's saved.
And I should have it